Hey guys, welcome back to the channel. It's me, Adam. You're watching Steady Invest. Canada's financial system has a strong global reputation for reliability and safety due to Canada's sound regulatory framework and relatively risk-averse approach. The Big Five, Canada's five biggest banks, make up a huge part of its economy, and all of their shares got absolutely clobbered during the sell-off in March. However, they're all fundamentally sound, provide good value, and pay out a dividend. And some of them still have a lot of room for growth still. And in this video, I'm going to be ranking all five bank stocks. And please understand that this list is completely subjective. So my favorite bank stock might be your least favorite and vice versa. And if that's so, let me know in the comments below. As well, I'm going to be talking about two ETFs that you can buy that have all these bank stocks together if you can't just choose one of them. And I'm also going to touch on covered calls and how they can help your banking investments. Before I do, if you haven't already, smash that like button. It helps my videos get out there. As well, if you're new to the channel, welcome aboard. Hit that subscribe button. And if you're in Canada and want to get started with Wealthsimple or Questrade and want to start trading, use my links below and we'll both get free money. Now let's get started. Alright, so the way I have it set up is that I have two tiers, an S tier and an A tier, because I don't believe any of these banks deserve any less than an A because they're all fundamentally sound. So the least favorite of my five is CIBC, and the reason for that is there's nothing particularly that I like about it, whereas with the other four, there's at least one thing I could say that I liked particularly about that bank. It is the smallest in market cap relative to the other banks as well, at almost $50 billion. And since the financial crisis 12 years ago, we see a 200% gain. It yields a dividend of 5.22%, which is pretty high. It does pay one of the highest dividends of the five, but for me, a dividend is only one variable, as I'm looking at total return on investment. And it trades at a forward PE of under 10 at 9.5, so it's really cheap. And I'm also not sure what kind of price appreciation I can be expecting over the upcoming years, as it has been trading sideways for the better part of the decade. However, it still does get an A, maybe an A-, but again, there's nothing particular that I like about CIBC. Alright, next up, BMO. It is the second smallest of all the five banks at $63 billion. It yields a 4.32% dividend annually. From the financial crisis until today, you see a 295% increase at a forward PE of 10.3, so a little bit more expensive than CIBC. But I do like their growth aspects in the sense that they're an investment bank. And as a result, I see more of a growth opportunity. In fact, they manage the ETFs that I'm going to show you guys later on in the video. So like CIBC, I'm also going to be giving it a minus as well. Again, it's a good investment. You can't go wrong because there's even more to like with the Royal Bank of Canada. It's the biggest in market cap of all five at $150 billion. And they serve clients worldwide, not just in Canada. It currently yields a 4.11% annual dividend. And since the financial crisis, had you bought at the lows, you would have made 250% return on your investment. Although looking ahead, I do like RBC's growth. They are unfortunately the most expensive, although 11 is still pretty cheap and is still good value. They deserve a solid A. Alright, next up we have Scotiabank. It's the third biggest of all five banks at almost $82 billion and yields a high 5.33% dividend annually. Since the financial crisis, we see a 160% gain. And what I really like about Scotiabank is that its forward PE is under 10 at 9.8. So it's very cheap like CIBC, but much bigger of a company. It's recognized internationally, and it pays the highest dividend of all five banks. Scotiabank also gets a solid A. And as you probably know by now, as process of elimination, TD Bank is my favorite and it deserves, in my opinion, an S. And why do I give it such high praise? Well, first of all, as you can see, there might be a little bit of bias. I do bank with them myself. It's the second biggest of all five at almost $128 billion. It currently yields a respectable 4.46% dividend annually. And since the bottom of the financial crisis, we see a huge 327% increase. It does trade at a forward PE of 11, which is expensive relatively to the other ones. However, relative to the broader market, 11 still is pretty cheap. And what I really like about TD is that they have large retail banking operations in the US. This gives excellent exposure to the growth of the US economy. And that growth really excites me for the total return on investment. Again, all these banks are still at excellent value even after the run-up over the past month. But looking at growth and stability, I really like TD Bank. And the first ETF is ZEB, which is BMO's Equal Weight Banks Index ETF. It yields a 4.24% dividend as of November 30th. But what I really don't like is this high management expense ratio of 0.61%. Because if you look at the holdings, why can't you just do this yourself? You might get charged commission, yes, but if you hold it for the long term, they'll pay for themselves. But I also understand if you just want to throw it in your portfolio this way, those fees are just so unnecessary in my opinion. But the ETF that I do like is ZWB, which is BMO's Covered Call Canadian Banks ETF. The fund invests in securities of Canadian banks and dynamically writes covered call options. The call options are written out of the money and selected based on analyzing the option's implied volatility. The option premium provides limited downside protection. The underlying portfolio is rebalanced and reconstituted semi-annually in June and December, and options are rolled forward upon expiry. Covered calls protect your investment, so if they go down, the damage isn't that much. But the sacrifice is that your ceiling isn't as high either. But that's more so true when there's a big amount of price appreciation in a small amount of time. However, by nature, banks go up steadily. And the best thing, on top of that, these covered calls actually raise the dividend. So you can see as of November 30th, the distribution yield was 5.92%. However, again, unfortunately, the management expense ratio is 0.71%. So you'll have to see if it actually fits the needs of your portfolio. But not a bad choice at all in my opinion. And as a side note, for a management expense ratio of 0.22%, Vanguard has a Canadian High Dividend Yield Index ETF, VDY, and it has a weighted exposure of 60% financials. And you can see the big five make up 7 of the top holdings. And the rest of the ETF are other high-quality Canadian high-yielding companies. And those are my rankings. And remember, before you invest in any company long-term, make sure you do your full research and due diligence beforehand. We're currently living through some wonky times, to say the least, and our economy isn't the most stable it's ever been. So make sure when you're investing, you have a plan and you stick to it. As always, thank you very much for watching. If you haven't already, smash that like button. If you're new to the channel, welcome aboard. Hit that subscribe button, and I'll see you guys in the next video.